What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the top 3 stocks that you should consider buying right now. So this is based on an article that I read from Investors Place, which they propose the idea for 7 stocks. Out of these 7 stocks, 3 stocks seem to be really attractive and to be a part of our watch list. So what I'll be doing for you guys is I'll be reading over this article, including those 3 stocks that I like, with my beautiful voice, commenting, and will be conducting my own quantitative analysis to see whether those 3 companies that I've been mentioning about or hyping about either belong in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being amazing, make sure that you do smash the like button. I know it's a little bit early to ask, but I hope that this video gives you a lot of value, as I did a lot of research and find out the fundamentals of this company for you guys so that you can make educated decision whether you want to buy or be a part of these 3 companies. So now, without further ado, let's get this video started. So 7 cyclical stocks to buy for a huge rebound. These 7 cyclical stocks to buy are excellent opportunities for the rest of 2020. Just keep in mind, out of these 7, we'll only be discussing about 3 and the article part of it that is mentioned in this entire article, because they seem to be really attractive. But if you guys do want to check it out, you can check it out by visiting the website, and the URL is mentioned on top of over here, right? So by Ian Bezek, Investor Place contributor. The stock market is booming. The Nasdaq exchange has surged to a new all-time highs despite the worst economic numbers in more than a decade. Investors have rushed into tech stocks. Now the euphoria is spreading. The S&P 500 has also reached new highs and crossed the $3,500 barrier for the first time ever. There's still an opportunity though. Where? In cyclical stocks. As you will see below, significant chunk of these stocks still haven't sprung back yet. The investors have gravitated to companies to have been benefited for the economic changes this year, but they have kept perceived losers in a penalty box. However, with the strength of the economic turnaround, even many industrial and cyclical companies could come roaring back. With so many stocks are already getting expensive over the past few months, it is time to turn on attention elsewhere. With these 7 cyclical stocks to buy, opportunity is still plentiful. So these are the 7 companies that are mentioned in this article, and these are the 3 companies which we will be looking at as it meets the fundamental rules that I look for, right? If you guys want to check those other companies out, you can do so accordingly. So now the first company in this list is Canadian Goose, ticker symbol GOOS. So it is no secret that retail stocks have gotten slammed in 2020. How apparel brands, for example, supposed to profit when people are stuck at home? Folks can't shop at stores, nor are there nearly as many occasions that require updating one's apparel. Still, the crisis has hit some clothing companies worse than others. Fortunately for us, Canadian Goose falls into the category of stocks that are still in the dumps but which actually are in fine shape. Sure, Canadian Goose just reported another weak quarter a few weeks ago, but really, when it is summertime, who's shopping for winter gear anyway? That's a good thing about how the virus has played out. At least as far as Canadian Goose goes, the company lost sales in spring and summer, which were never pivotal seasons for it anyway. Now, after the months of being cooped up at home, folks are looking to plan vacations and they break their cabin fever. With the time of skiing and other winter sports right around the corner, now is the time for Canadian Goose to start revving up its sales engine. And consumers aren't in bad shape thanks to all the government stimulus. There will be some cash available for indulgent spending this holiday season. Canadian Goose, with its strong direct-to-consumer channel, should be able to post a rapid recovery. So that's pretty good looking at this perspective. But in order for a company to basically meet our dividend portfolio, it basically needs to meet 4 rules, right? And these 4 rules are derived from this books that I've read, which I highly recommend checking out. So the rule number 1 is that it needs to have positive free cash flows. So what do I mean by this? So we want to be looking for companies that are bringing in actual cash into the business rather than showing it on paper, right? And rule number 2 is that the dividends paid out should not be more than 75% of the current free cash flows, meaning that at least 25% of the free cash flows, or the money that the company is able to generate, is being retained by the company to either make mergers, increase the top line, which is basically the revenue or sales, or pay off its long-term debt if the company chooses to do so. And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. So we want to be investing in companies where their motto is to pay out its investors in the form of dividends, and some companies grow these dividends at an particular rate, and we want to be looking for companies that have been doing so for at least 5 years or more. But if you want to be on the most conservative side, you can consider 10 years as the minimum as well. That's up to you, and that's up to you what you guys decide. Now, rule number 4 is that the current dividend yield must be greater than or equal to the 5-year dividend average. So rule number 4 basically lets us know whether it's the right time to buy the company when it is at a bargain or it is on a fire sale. Okay, now let's have a look at these fundamentals. So I'll be using Y charts to get the data out here for these companies, because they do a really good job of representing the details in a visual aspect rather than looking at boring old numbers and doing some spreadsheet calculations. So looking at Canadian Goose Holdings, we can see that it does have a current positive free cash flow, but it doesn't pay out any dividends at the moment. As a result, it can be a part of our dividend portfolio for that reason, because dividends are the main criteria in order to be a part of that portfolio for the average annual investor out there. Now, looking at the value perspective, in order for a company to meet the value portfolio, it needs to meet at these 5 rules. The rule number 1 is that the return on invested capital must be greater than or equal to 10%. So what this literally means is that the higher the number, the more profitable the company is, right? And rule number 2 is that it needs to have consistent free cash flows so that we can predict the free cash flows 10 years from now to a certain extent, or like give it like a hunch, right? And rule number 3 is that it needs to have a strong balance sheet. So a good way of looking at this is that company takes on long-term debt in order to grow its business, but we want to be making sure that the company can clear out this long-term debt within 6 years or less. The lower this number, the better. And rule number 4 and rule number 5 are our buy criteria. So we only want to be buying the stock when it is at least at a 20% markdown from its fair price, which we'll be calculating in a few moments. That's basically calculated by multiplying 80% by the current price, which should give you at least a 20% margin of safety. Now, rule number 5 is we only look at it if rule number 4 isn't met. The criteria is solely based on the PE ratios. So if the price to earnings ratio, that is the current price to earnings ratio, is lesser than or equal to the 50% of the highest price to earnings ratio over the past 5 years, and it must be cheaper than the S&P 500 index, right? So looking at this, we can see that Goose current price to earnings ratio is 35.72, which is definitely higher than the S&P 500 index, which is 29.46. So the rule number 5 gets out of the door instantly because of that reason. Now, what we can do is we can see if there is any value that we can derive from by buying the stock by calculating this intrinsic value of the company. So ticker symbol GOOS. If you were to look at the return on invested capital is 25.75%, showing that the company does have some sort of competitive advantage. And the lowest that I could find was from 2017, which was around 7.54%. And the net cash flows, it's all over the place. So they have been increasing its net cash flows from a minus, I would say, $900,000 to a positive $150. It's not that consistent, but let's check out its balance sheet from this perspective. Okay, so the balance sheet is $267 million in its long-term debt, which it can easily clear off with its total current assets, which are nothing but the assets that can be converted into cash by the management within 12 months or less. So it does have a strong balance sheet, Looking now, let's calculate the intrinsic value of the company. So the earnings per share is 910 cents. Now let's see what range the price to earnings multiple it has been trading for over the past 5 years. I think I just typed in too many letters there. Yeah, Canadian Goose and the analysts are expecting that the company could grow around 28.57% year over year growth rate. So let's just put that in 28.57. Now, what we're doing here with this growth rate, we're projecting the earnings per share for 10 years from now. And once we get the earnings per share 10 years from now, we want to be multiplying with the suitable price to earnings ratio so that we can arrive at its intrinsic value, right? So in order to calculate that price to earnings ratio, there's two ways of looking at this. You can either consider the 5-year average of the price to earnings ratio or multiply the analyst estimates times 2 to get a multiplication ratio for you to consider as the price to earnings multiple, right? Looking at this, the price to earnings ratio for the 5-year average is 90.95, which is definitely high. When compared to the analyst estimates times 2, you'll be getting somewhere around 57.14, which is definitely a high number. And looking at the current price at which Canadian Goose is trading at, it's $25.80, and the right price at which we should be buying the stock would be at a 50% discount from its fair price, considering a 15% return on our investment. So basically, scratch all that, the intrinsic value 10 years from now, considering the analyst growth rate, it's going to be around $500. And the fair price at which we should be buying the stock today, bringing it back to present value, considering a 15% return on our investment, is $141.89. And the price at which we should consider entering the stock is at least at a 20% margin of safety. That is around $113.51, which is definitely a bargain when compared to this. But I am a little bit hesitant when compared to the growth estimates, which is around 28.57. Let's say, just for the sake of it, if you consider 15% rather than like by half, it would still put the company at an intrinsic value of $96, and the right time to buy it would be around the fair price of $27, and the 20% markdown would be around $21.84. As a result, that is a conservative estimate that we tried out, but I would consider buying Canadian Goose stock at its current price valuation because of its intrinsic value. As we can see, it is around basically more than a 50% discount from its intrinsic value. Now looking at the price, it's around $25.80. So we want to be investing this as a value portfolio as rule number 4. Now let's have a look at the next company in this list. Out of all these, next company that I've selected is D.R. Horton, ticker symbol DHI. So, and on the topic of housing, we have D.R. Horton. You may make an argument for owning most of these different home builders here. Given the boom in the housing market and the Federal Reserve promising low interest rates for years to come, the sector should be profitable for a long time. That said, if you want a safe pick to ride the trend, give DHI stock a look. It is one of the nation's biggest and most diversified home builders, as it currently has a market capitalization of more than $26 billion. This means you aren't taking undue risk on any one particular geographic location of the country. Additionally, the housing boom is showing up in D.H. Horton's numbers. The company reported home building revenues up 11% over the first 9 months of its fiscal year. That is pretty remarkable, since much of the country was under lockdown orders for a good chunk of Q3. Just imagine how much momentum the company may be able to pick up with the first quarter of sales in Q4. To that end, the company reported sales orders surging 38% during Q3, pointing to a huge growth in the backlog going forward. Earnings also soared to $1.72 per share on the quarter. That was way ahead of the analyst estimates for a profit of $1.26 per share. There is no need to overthink this one. Housing is red hot right now, and home builders such as D.R. Horton have more upside ahead. Okay, D.R. Horton, ticker symbol DHI. Definitely a discount when compared to the S&P 500 index, which is around, in its current price to earnings ratio is 12.36 over here. Now, let's see if it can be a part of our dividend portfolio. Ticker symbol DHI. So the revenues are almost linear, but the free cash flows here, it hasn't moved that much. It's basically mostly on the sideways. So less than 5% growth year over year on an average over the past 10 years. But the free cash flows are definitely a positive, and it's paying out $223 million out of its $764 million of free cash flow, which accounts to around 30%, meaning that the remaining 60% can be reinvested back into the business. So a good payout ratio, looking at that trend. Now, let's see if it has been increasing its dividends over the past few years. Looking at the dividend growth, we can see it has been paying out dividends since 1998, and it's been growing its dividends for the past 6 years at a rate of 25%, which is absolutely bananas, and it will do wonders at this compounding rate, right? And looking at this number, just imagine you increasing your salary year over year for doing the same amount of work at your workplace. Similarly to this, just for owning the stock, your dividend is getting increased at around 26% year over year. I don't know, 5-year average range. So definitely meets the third criteria. Now let's see if it is at a discount at the moment. So now, typing in DHI stock ticker symbol, we can see that the current dividend yield is 1.03% and the average is 1.12%. So we only want to be buying the stock when the current dividend yield is greater than the average 5-year dividend yield average. In this case, wouldn't be buying the stock or jumping on it right now, but at its current valuations, this does seems to be pretty attractive as in terms of a dividend perspective, but I would be waiting on it or add it to a part of our wait list. Just for fun, if you were to invest in the company back in March of this year, when the dividend yield was around 2.26%, you would be basically getting 2% of your investment year over year just for investing in the stock, right? And if you were to look at the price fluctuation from then to then, your price would have been appreciated significantly. So March, around $31. Within a few months, right now it's currently trading at $68.23. You would have literally doubled your money if you had invested in D.R. Horton at that particular point in time. So which is pretty good. This is definitely a good stock that we should consider buying in our dividend portfolio, but we want to be waiting for it so that at least the price falls down in such a way that the dividend yield catches up to the average dividend yield, average of 1.12%. Now, looking at the value portfolio, let's see if it meets a part of our value criteria. DHI. The return on invested capital, definitely a positive looking at the current situation, which is 12.42, and the minimum that I could find out somewhere around 1.57. That was around 10 years ago, back in 2011. And does it have consistent cash flows? Yes, it does have consistent cash flows with the momentum here and there. That's expected when compared to the housing market, right? And real estate and housing market, because all of this goes in sort of like a wave in a cyclical format. And let's see its balance sheet. So we can see that it has total long-term debt of around $4 billion, which it can easily clear off with its current assets of $14.51 billion. So definitely a strong balance sheet from that perspective. And now let's calculate the intrinsic value of the company. So the earnings per share is $5.53 per share, and it has been trading. Now DHI has been trading at a price to earnings multiple of 6.123, 19.80. DHI, and the analysts are estimating that the company can grow at around 18.6%. So that would put our intrinsic value of the company as $332, and the fair price at which we should be buying the stock is $94. And the right time to buy the stock would be at least at a 20% markdown. We can still consider entering into the stock in terms of a value perspective because of its current valuations based on rule number 4. So dividend, wait, value, start buying, I would say. In terms of a dividend portfolio, I would recommend waiting, but if you want to buy in terms of a value perspective, it does seems to be at a minimum of 20% discount from its projected growth rates, right? Now, just for fun, let's have a look at the 5th rule as well. The current price to earnings multiple is lesser than the 5-year highest average. So that would be 19.80 divided by 2. It needs to be 9.9% or less in order for us to invest it in terms of rule number 5 of our dividend portfolio, of our value portfolio basically. Since the price earnings multiple is 12.36, which is significantly cheaper when compared to the S&P 500 index, you can still, we can't consider that based on rule number 5, but in terms of the intrinsic value, definitely a yes. But if you want to buy it in terms of a dividend perspective, I would recommend waiting for the price to come down a little bit. Now, coming to the last company in this list, which I've selected for you guys, is Thor Industries, ticker symbol THO. Thor Industries is not a household name for many traders. However, the $5 billion market capitalization company should be on your radar. Thor makes recreational vehicles, RVs, thus it is in a highly cyclical industry, as RVs are somewhere between autos and houses in terms of purchasing behavior. These are big ticket purchases and require consumer confidence to generate strong sales. At first glance, then, it's not all that surprising that Thor stock is trading down by more than by a third from its 2018 peak. With the economy in trouble, an RV maker may not spring to mind as a logical purchase. But think again, a surprising number of people have taken the recreational vehicles as a safe way to travel the country. You get the thrill of not being stuck in one place during CVPD, while also not having to share your surroundings with strangers that may have the virus. Long story short, RV sales are positively soaring. For July, for example, they hit their highest point of 2020 and are up double digits from the same period of 2019. Thor stock is now up on the year, but it is still way down from its 2018 peak. And Thor shares dipped again in August, falling roughly 12% in recent weeks. Thanks to that, the stock is now going for a measly 17 times forward earnings, even as the company is picking up speed. Now let's have a look at Thor Industries. We can see that the price to earnings ratio is definitely at a discount when compared to the S&P 500 index. Typing in Thor Industries here, in our value charts, you can see that the free cash flows and the revenues have been increasing consistently, so that's pretty good. The dividend is paying out $84 million divided by 377. Around 20% of its dividends is being paid out of its free cash flows is being paid out as dividends, showing that at least 80% is being reinvested back into the business in order to grow its top line along with its bottom line. So definitely a yes. And let's see how consistent Thor Industries has been increasing its dividends over the past 5 years, or the past history. If you were to look at it, it has been paying dividends since 1990 and has been increasing its dividends over the past 9 years at a rate of around 9.58 compounding annual growth rate on a 5-year basis. So definitely meets the third rule as well. Now we want to be finding out whether Thor Industries is the right time to buy this company at. Looking at Thor Industries' current dividend yield is 1.74, which is very close to the average dividend yield of 1.84. But I would be holding off to this in terms of a dividend perspective because we want the price to be coming down a little bit. Currently at $92.04. Dividend perspective, dividend waiting for that. Just for fun, because I know Thor Industries has performed really well. Back in March, if you had invested in this company, I want you guys to imagine, just for owning this, you would have gotten 4.5% return on your investment year over year, just for owning this company. Just for owning it. It beats out any market, or it beats out any, what do you call it, bank fixed deposits and your savings account by leaps and bounds. And not only that, this percentage gets increased year over year at a rate of around 10%, which is just bananas, guys. And just for fun, just to show you the powerful theory behind the dividend yield theory, if you were to invest in the company back in March of 25, March 18th of this year in Thor Industries, you would have got the price around $34, and the company just literally doubled, guys, literally doubled from here to here, around $120. So you would have gotten nearly around 200% increase on your investment just by owning the stock within 3 to 4 months, which is just phenomenal, guys. And you can definitely consider it as a long-term hold as well. But at its current valuations, in terms of a dividend perspective, I would recommend holding off on it. Now, coming to a value perspective, let's have a look at Thor Industries. The return on invested capital is 4.49%. As we can see, the average has been pretty good. The return on invested capital over the past 10 years is about 20%, but it did take a hit back in 2018 or 2019, which is around 4.49%. As a result, the first rule isn't met, but in terms of the revenue, it has been increasing consistently. So it was around $81 million. Now it's around 377. So 80 double is 160, 160 double is 320. 320. So around 20 to 25% year over year increase in terms of its free cash flows, which is a pretty good number, and it has been paying out its dividends consistently as well over the past 9 years to the last time that I recollected that. And it does have a strong balance sheet because it has around $1.983 billion, which it can easily cover with its current assets of $2 billion. So definitely within 12 months, it should be able to clear off its long-term debt if the company chooses to do so. Now let's calculate the intrinsic value of the company, which we can see its earnings per share is $3.54. And it has been trading at a price to earnings multiple of 7.909, 34.11. I don't expect that the growth rates would be that phenomenal when compared to other companies like Goose and stuff. So THR. Alright, analysts are estimating that the company can grow up somewhere around 5.9%. So considering this, the intrinsic value would be somewhere around $69.98. The fair price at which we should be buying the stock, $19. And at least a 20% discount from its margin of safety would be 15.91. And just for fun, if you were to consider 21, it would still be expensive when compared to the price to earnings multiples. It does seem to be on the expensive side, but if you were to invest in Thor Industries from a dividend perspective, I would recommend holding off until the price comes down a little bit low, and then you can buy this company in terms of a dividend portfolio, but not in terms of a value portfolio per se. So these are the companies that I felt that were really good, either to buy right now or otherwise hold off from different perspectives or different angles. So this is just a framework, guys. If you guys believe that there's other ways of valuing the companies much better, I would highly recommend that you leave comments down below regarding that. And closing remarks on this article is that on the date of publication, Ian Bissek held a long position in PII. Ian Bissek has written more than 1,000 articles for InvestorPlace.com, Seeking Alpha. He also worked as a junior analyst for Cardell Capital, a $300 million New York City-based hedge fund. You can now reach him on Twitter at IRBissek. So thank you guys if you have stayed around till this part of the video. I do want to let you guys know, full disclosure, that this video is for your education and entertainment purposes only. Make sure that you do your own research before investing in these companies, because whenever you're investing in companies, there is a risk of losing your principal if you don't do your research properly, right? So please do consult your financial or tax professional prior to making an investment in these companies. So if you guys feel like being awesome and want to stay updated with all the videos that we post on the channel, just remember we post from Monday to Friday every single day, apart from the weekends basically. So make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post these videos. So thanks for watching. Catch you in the next video. Peace.